Hello everyone, welcome to another episode of Wealth Talk by Vivekam. So in the past few weeks, we have seen a lot of analysts come out and say that these valuations of these stocks are very high. Maybe it is time to move on from some of these stocks, park some kind of fund somewhere else, and then maybe come back to them when valuations seem more attractive, is what some of these analysts have been saying. Of course, it is very discouraging to see that because we have to have a deeper look into the numbers to see how corporate India in general is performing and then make an assessment if the valuations are indeed overvalued at this current time. But when we look at the facts, corporate India has been increasing its profits. Like in the year 22, financial year 22, those numbers went up by more than 50%. The same profits in the next year, in the financial year 23, went up by more than 9 to 10%. And in the latest year, financial year 24, they went up again by more than 30%. So, when on one hand, the results, the profits of the corporate India are increasing, they're showcasing their strength, why would stock prices also not bear the kind of same trajectory? That is why it always makes sense, and you as an investor to ask yourself, when analysts come out and say a stock is overvalued or undervalued, is it also reflecting into the numbers of the company? If it is actually reflecting in the numbers of the company, it merits discussion to actually look into that. But when there is only blanket statements being done just because Nifty has hit highs or Sensex has hit highs, it should always be backed by some data. And when corporate India continues to do well, I don't think there is any cause for concern for you or me as an investor to move in this market. On the one hand, we have talked about profits, and I'm sure we also that also directly relates to the advanced tax numbers that have come out, which are again promising, which showcase the strength of corporate India at this time. Now, as a simple example, during this ambiguous time during election results when market was very volatile, we just did a quick study to see how the companies have done since that time. So we did a simple study where we took Nifty 500 stocks and just looked at how the prices of the stock has moved since that June 4th, June 5th timeline of the election results. Surprisingly, more than 90% of the stocks have grown by more than what the index has grown. Nifty index has grown in the same period. Nifty index has grown around 7.4%, but in reality, 90% of those 500 stocks have grown in the same period by more than that time. So this implies that market is strong, the fundamentals are strong, and we should not look at independent activities like volatility in the market to drive our decision making. We should look into fundamentals, and that is what we anyway predicate and we talk about at Vivekam, where you need to identify fundamentally strong stocks first and foremost. Next, stocks that are undervalued, which are again fundamentally strong. So why is this relevant is what you may ask, because we talk about something called fair price, where this is the value of a particular stock for the upcoming quarter alone. We look at the fundamentals and come out with a number that we believe is an accurate representation of the value. So the next question for you as an investor or a client or someone who is interested into this topic should ask is, how or why is this fair price important? So we take this analogy of whenever you get onto a train, you go from point A to point B. When you go to your destination, it is imperative that you get down of that train and move on and do your work. Just because the train is going somewhere, you should not continue to be in its journey. So that is the same analogy that we kind of relate to stocks, where we believe each stock has kind of a fair valuation of what it's worth. So just as an exercise, maybe Mr. Prasad, you can talk a little bit about why this is important. And it is usually more important whenever you showcase or we showcase real life examples of what could have been, would have been had people followed this practice of following a fair price.
Okay, Ashwan. First of all, I need to tell all our investors there are two things. Number one, if the markets go up, if the market commentary is that the markets are overvalued, the valuations are too stretched, one must understand in context to what. Just because they are trying to compare the performance of the index over the 2 years back level, it is meaningless, because index comprises of stocks, and stocks are actually profit producing engines. So when they produce more profit, nobody should be foolish to say it has gone up, because obviously when the profits are more for the companies, the prices are supposed to go up. So index levels also are supposed to go up. So it is a given thing. And having said that, the people who start tracking fundamentals and base their decisions purely on fundamentals, whenever the markets tend to move up fast, they will be happy because if the stocks do reach the fair price set by them at the time of buying, they will be fearlessly exiting from the stock. Because they exit, they will have money and they will be fearlessly deploying the same money in some other value share which is available at a discount to the fair price, because they knew that we have already identified some stocks at a lower price. They reach the fair price, so let me recycle the money so that I will continue to be in good stocks which are underpriced than just staying put with the same investment. But who do not sell are the people who are not aware of the fair price, who have no basis of understanding to evaluate any stock and then give a value to that. To prove our system systematically over the period of several years, we have been giving statistics to our investors how many companies, how many stocks were hitting the fair price. Many people keep on asking us still, whenever we give out a fair price, they say, what is the timeline? The timeline is not to be counted. We don't even care about the timeline. All that we say is, based on available information, this is the fair price. It should be trading. If it reaches there, we get out. If it doesn't reach there, we hold on. And fair price gets revised 4 times in a year whenever the results are out. So you have a floating fair price dangling in front of your eyes so that you know when to exit if the stock price tends to move up. That is the analogy. To prove that point, I would request all of you to pay attention to the slide on the screen. If you can look at this, there are about 15 companies which have been suggested to be exited because they reached the fair price from last 15 days of June month and first 5 days of July. So in about 20 days period, there are about 15 companies which have reached the fair price. This answers many people's question, what is the validity of the fair price? When they reach, it is validated. If it does not reach, we will wait till the time it reaches or when the new fair price comes out so that we can again compare. So now if you see, the first company that was recommended to be exited was on 6th of 21, that means June 21. We suggested to be sold at CE Info Systems at 2,746 and subsequently it went down. I am not trying to prove a point that after we sell it goes down. This is not to prove that. All that we are saying is some companies go down after we sell, some companies do go up also. As you can see, the second company 361, we recommended at June 28th at 1065, then it went down to 964. Like Magad Sugar, Jansa, there are a few more companies which have slightly slipped from the time we sold it. But if you go to the bottom of the list, you will understand DB Corp also was suggested for us to be exited on July 1st at 347. But after we suggested an exit, our clients have exited. They use the money to buy some other stock which is available at a lower price in the same lines of how they picked up DB Corp some time back. But the stock has gone up. That means after selling, if the stock goes up, none of you need to be worried because you know that money is not going to be lying idle with you. That money will be redeployed or recycled into the growth stocks which have further growth to go up than the possible opportunity you might lose if you do not know. That means if you are afraid to sell DB Corp, fearing that it may go up, that's okay. 5% you may have cash not today, but the money that you realize from DB Corp would have been deployed in a better stock. So all that we try to say is, if you follow the principles, you will be able to gain much more money and then stay peaceful also. That's the intent more than anything else.
Right, Mr. Prasad. So individual stocks, you talked about the EMP or the fair price that we talk about. But in the past, we have also discussed few industries. Industries in the sense, a set of these stocks that belong to a particular sector and have a good kind of scope of growth, again, based purely on fundamentals. So maybe we can touch base again on those industries, specifically something like defense and auto ancillary stuff that we have discussed in the past, and see how this kind of model related and has performed in the immediate kind of last 3 to 6 months.
Okay, Ashwin, it is easier to explain with the facts because whenever we talk about a process and then kind of hypothesis, if we present the facts before the clients or investors, they will find it difficult to throw it away as a kind of not a valid argument. So now what I want to present is, when 2023 December quarter results were announced, we routinely do it every quarter, not just like 2023 December is special. All that I wanted to say here is we come up with fair values for all the stocks that are doing well. And in this work, what we normally do is in order to ensure that the people don't get trapped by small, tiny companies or micro cap companies or even very small companies, small cap companies, we set a filter of more than 5,000 crores as the minimum limit. That means for us to understand or classify or consider a company in our approach, we want only 5,000 crores plus category. And if there are more than three stocks in any particular industry, then only that industry will come onto our dashboard, and then we try to give fair values for all the stocks covered in that industry. Some stocks may be overpriced, some stocks may be lower underpriced. We don't care. We come up with our fair value based on our model and give a fair expected value of the market capitalization. Once the expected market capitalization is given, we also take a comparison with the existing market capitalization. If the gap between these two industries is wide enough, that means the industry level market cap gap between expected market cap and existing market cap is wide enough, we normally show it as the top of our list, saying that there seems to be some scope in these industries. Now you can see the screen, and on the screen I presented about 6 or 7 industries which were highlighted in one of our earlier videos, where we said defense has got about market cap of 5,83,000 crores at that point of time, and it has the potential to go up to 11,44,000 crores. That means a gap of 96% on the upside. Like that, railways was given 85%, electric equipment was given 76, and automobiles was given 68, and like that. The last insurance industry was given 53. For our today's analysis, we will only cover top 5. People understand the relevance of industry-wise expectation being holding true. Now, if you go into the first slide, which will be on the screen now, you will see that there were 15 companies from the defense industry which had more than 5,000 crores market cap. And how they appreciated, because December results would have come by February ending or February middle. But afterwards, now I'm trying to compare how this industry has done in the last 90 days. That is, because we are in July, that means it must be from April 7th, 5th or 6th of kind of onwards. So in the 15 stocks that are covered in the defense, if you notice, the lowest market cap touched by this company in the 90 days was 6,89,000 crores, whereas it went up to 11,68. It has appreciated up to 69.62% in the last 90 days alone. That means the industry that was identified as the top favorite, top scope to grow at 96%, has caught up with around 69% in this last 90 days itself. That is, the momentum continues once the momentum is set in. Now, having said that, let us try to roll our study into railways also. In the railways, if you see, there were 8 stocks which had more than 5,000 crores market cap, and 3,67,000 crores is the minimum market cap touched in the last 90 days. And then it went up to 5,32,000 crores. That means it grew up by 45%. In here, I want to make a special mention, because what happens for a trader versus investor can clearly be understood from this graph. If you notice 2 red bars on the screen, you understand that the market has gone down very badly on the date of announcement of actual results on June 4th. Why? Everybody thought Modi government may not be coming back to power. Everybody sold. But who is that everybody? The traders, the speculators, are the people who are doing it on leverage out of fear that something bad may happen. They sold out. But you and me, if we are confident about our own approach, about the numbers that are backing up our argument, we would not have sold even 1 share. That means we would have continued to stay invested in them, whereas traders and speculators try to run away from them. So the markets have gone down very heavily. But what happened after that? That means almost like 12.5% has gone down in the 2 days, but then it caught up again. Now, finally, if you see, 45% jump in 90 days is not a small thing. That is about railways. So if you are a trader, you would have closed your positions by applying the stop loss. But if you're an investor, you would have continued your joyride even today. And now let me roll back to the next thing, that is automobiles. And automobiles, what has happened, as you can see on the screen, there were 11 stocks which were more than 5,000 crores, but auto industry has not really caught up with the rise like the other industries, because automobile is not the favorite of the government. That's what many people believe. So it went up still by 19.56. Though it is not touted as the market favorite, still it went up by 19.56% in last 90 days only. So imagine 20% in 90 days is equal to 80% rise in the year. So it is not small by any means. But in comparison to other top industries, it did not do so very well. And afterwards, after automobiles, we'll consider electric equipment. because we have been always saying when the infrastructure push comes in full play, the major industry that is going to gain is also electric equipment. As you can see, this industry also suffered on 4th of June, and but immediately caught up, recovered, and then went up. And in these 9 companies, there is a gap, there is a rise of 40.86 or 41% in the last 90 days. And finally, to cover the auto ancillaries, because auto ancillaries, is normally a cluster of small companies clubbed together. Any company that has more than 5,000 crores, there are almost like 100 companies in auto ancillaries, but we tracked only 24 because more than 5,000 crores is the filter. And in these 24 companies together have appreciated in the last 90 days by 42%. So now you understand the power of estimating based on the hard data, not on a gut feeling, not on a bias, or not on our ability or claimed ability of being able to see the future or forecast the workings of all the companies. We do not do that. If we are conscious to work with the data that is presented in front of you, which is vetted by the regulators and believed to be true, and if you base your judgment and if you buy your stocks based on the fundamentals, you will surely stand to gain. This is what we wanted to cover because not many companies are going to come out with the results in this quarter, this week. Next week onwards, maybe next week also we'll cover 1 or 2 industries, but afterwards we will come back to the analyzing the companies so that you will be able to find the new treasure in the new list of stocks that reported far better improvement in their workings, yet they seem to be underpriced at that point of time. Let us wait till that time, and I hope you will enjoy this analysis.